That is exactly where we're headed, where you have an unbalanced economy, an unproductive economy, but it's marked by inflation, and that's stagflation, which is the worst condition. It's the worst that you can imagine. It allows for a wounded economy that never heals. Because don't forget, if they did the right thing, which is allow market forces to play out, it would be a much deeper wound, a much more biting wound. It'd be much more pernicious, but it would be truncated in nature. It would not last, wouldn't be protracted. But I'm afraid what they're going to do is going to just protract the malaise for many, many years. So I have a model called the inflation-deflation economic cycle model. And the way I look at investments is this. First, I ask myself this question: where are we on the rate of change or the second derivative of inflation? So are we in a period of stasis? 3%, for example, would be a stasis where I don't think inflation is going to change over the next few months. Now, there's disinflation. That's one sector where the rate of change is falling. Then there's deflation, where prices are actually dropping. That usually happens in recession. So I identify which bucket it's in. There's also reflation and stagflation on the right side of the sectors. There's 5 sectors that we could be in. And once I identify that, and I use my model to identify that, it took me decades to create this model, but it's pretty damn good at identifying what sector we're in between stagflation, reflation, stasis, disinflation, and deflation. And then I ask myself another question, second question, is what is the economy doing in relation to that inflation, deflation dynamic? Is it a healthy kind of reflation? Is it a healthy kind of disinflation? Or are we deflating where liquidity crisis? Or are we in for stagflating or running intractable in the inflation where we're killing the economy? And then I asked myself the third question, which is, okay, now that you know where inflation is heading, and now you know where the economy is and heading, how dangerous is the macroeconomic construct? In other words, do we have asset bubbles and do we have credit bubbles? Because that informs me how damaging the reconciliation process can really be. So that's the model. And now you ask me where I am. So the model tells me we're heading from stasis, which is, a rate of change is static, to disinflation. I think the next step would be disinflation. And then I also believe that there's a high probability of heading into deflation and recession later on in this year, with Q4 or maybe even Q1 of 25. The Fed's reaction function to that, which would inform me whether how long we'll stay in that and when we go back to reflation and then eventually stagflation. Each sector has its own style factors and currencies and commodities and equities that you should own. So for example, when you go towards sectors 1 and 2, you want to overweight bonds. It makes sense, right? And you want to eschew high beta stocks, small cap stocks would be out. And the opposite is true. When you're in sectors 4 and 5, a healthy reflation or stagflation, you want to own base metals and energy, higher beta equities. I also would tell you that gold tends to do really well in sectors 1 and 2, which is why gold is doing so well. I don't think they understand the difference between deflation and rate of change and disinflation. I don't think they understand it. Because if you have inflation go from 9 to 3, prices aren't falling. Inflation hasn't been vanquished. Inflation is still rising higher from a level that's unaffordable. Prices need to fall. That's deflation, sector 1 in my model. Not rise from, going up from 9 or actually 18, 19, 20% to 8%. In reality, that's not what they need. That's not inflation vanquished. It just means, we're not killing you as fast as we used to kill you, but you're still being killed. So I don't know what they're celebrating. I really have no idea what they're celebrating. I guess Wall Street likes it because, hey, it means that, the Fed can start cutting rates. Oh, isn't that wonderful? We can go back to the same crap, the same playbook that we've done over and over and over again. And then you see the bifurcation of this nation. You cannot have a healthy country without a vibrant middle class, because those are the people that actually go to work. The poor people collect from the government. Rich people get checks from rental income and dividend income streams from bonds. The people actually work are the middle class. And we should give a damn about them. I do. I'm not one of them, but I do care about them because I care about this country. It's a wonderful experiment in freedom that's gone awry. It's a failed experiment. We elected people to represent us and gave them too much damn power. And who gave these people the power to take the currency and rip it to shreds? I never said to Ben Bernanke and Janet Yellen and Jerome Powell, hey, why don't you print trillions upon trillions upon trillions of base money supply and tell me you're doing it for my good? I never voted for that, and I never would, and nobody ever would. The base money supply should rise commensurate with what GDP rises, which is around 2%, which is the productivity increases plus the labor force increase. That is it. Money supply, as measured by M2, was rising at 20% per annum levels. That's a sin. Go around to some of these cities and tell me what you see. It's a sin. I live in Florida, and it was 1 in 5 drivers, 1 in 5, 20%, don't have insurance, but they drive anyway. You know what the fine is for that when you drive without insurance? Well, they take your car away. They impound your vehicle, and the fines are off the charts. But people are doing it anyway, risking the removal of their vehicle because they can't afford it, but they're driving anyway because otherwise they won't be able to feed their families. Like I said, you cannot have a country that's healthy without a healthy middle class. And that's been borne out, been verified throughout history, not just in the United States, but around the world over time. The only remedy is to maintain the level of Fed funds above inflation for a period of time until asset prices correct. The only problem with that is that asset prices and debt levels have gone to such an extreme level that there isn't just a mild recession that would be the result. So we talked about what would occur. You asked a very pertinent question. Where would asset prices go? Well, home prices would drop 40%, I answered you, and I also answered you that equity prices would drop about 40%. What bank, what pension fund, what off-balance sheet private equity fund would be solvent? Even the government would be insolvent if we allowed the free market to function right now. It would be a devastating depression for a while. That's the conundrum here, because we've gone past the time where allowing the market to work would be painful but doable. Now it's pernicious and would lead to utter penury for America if we allowed a 40% correction, because there wouldn't be a solvent bank in the country. There wouldn't be a solvent pension plan in the country. Private equity would be bankrupt. Private credit would be bankrupt. CLOs would go belly up. So I'm afraid that they, being Treasury and the Fed, will do what they always have done. That's what you're going to get, your stagflation like we've never seen before. Yeah, I had this conversation this morning with one of my employees, and the contention was, well, maybe they'll cut and they'll save the real estate market. And I told her, I said, well, wait a second. You know where the 10-year note is right now, right? And if you look at LIBOR and 10-year note, so far, LIBOR, 10-year note, that's where the mortgage rate's priced off of. It's already 4.2%, 4.18 to be exact. I mean, Powell's rate cuts have already been very well telegraphed. No one is going to be surprised by these handful of rate cuts that are coming. What he would have to do is he would have to surprise the market with a 50 basis point rate cut on Wednesday. That would really get things going, and the commodities and the dollar would crash and commodities would soar, and maybe you'd get some relief in the housing market. I mean, housing prices would go higher from where they are. So you get the rate down a little bit. And then, the salient danger here is that the 10-year note the yield goes up. So the price goes down, the yields go up. Not too long after the Fed starts down that road. That's what so you have the re-inversion of the yield curve, where the Fed funds rate would go down, so the money markets rates would go down. But anything priced off the long term, the long duration bonds, would go up in yield. And that's not going to help out. So the remediation or the salve has gone away. Now, the Fed could do something on a twist and just buy the heck out of everything that's long duration. Can you imagine the ramifications for the currency if that was to happen? They're going to go out and start gambling on 30-year bonds and financing all their debt there. The interest rate would be, $2 trillion that we're paying. The interest expense would be, $2 trillion a year. There's just no easy way out of this. The US dollar has been losing its world reserve currency status for a very long time. And there's many reasons for that. First of all, one of the primary reasons is the use of tariffs and usurpation of foreigners' bonds, their currency reserves. So for example, if you have an argument with the United States can tell Russia, you actually sold us more goods and services than we sold you, so you have a surplus. You're going to place your currency reserves in our treasury market and in our dollars. And then when we have a fight with you, we're going to tell you that they're not yours anymore. So they say, and then Russia and China and Brazil and all those other countries that keep their currency reserves with dollars are saying, well, we're going to obviate your ability, preclude that from happening. So we're going to sell treasuries and we're going to sell dollars and buy gold. And we're going to hold our own wealth in our possession. And that is exactly what's happening it's not a new phenomenon. I then think as this recession becomes manifest, you might see this reflexive Pavlovian move into the dollar, because it's just a rewind of carry trades. So what happens with the yen too. So people borrow in yen, they borrow in dollars, they buy higher yielding currencies and higher yielding debt. And then when things go sour, they have to unwind that trade. So they sell their domestic holdings and they have to buy back the dollar to close out the trade. So there might be a window where the dollar rises. But then after that, I think we're going to see a really significant plunge in the level of the US dollar. I'll say not just against other foreign currencies, not just in the FX market, but you'll see it really manifest and bite hard when it comes to the dollar versus hard assets. And that includes base metals and energy, and especially precious metals. And no, I don't sell gold. I'm not in the gold business. So there are times when I have no gold. I always start with 5% gold that you should have in your physical possession, because gold is not an investment. So just when you thought I was a gold pimp, I am not pimping gold. All right. I am telling you that gold is not an investment. What gold does is maintains your purchasing power. I don't care what happens with the currency. I don't care what happens with the country, with the banking system. Your purchasing power never will change. Now, an investment is something that earns you money above the rate of inflation. And that's not what gold does. It just maintains your standard of living. So I start with 5% of your net worth. That's what should be held in your purview. And then as an investment, I toggle between 0 and 20. Right now, I'm 10% in gold. Now, with the one caveat I will tell you is that if we go into sectors 1 and 2 is where gold really thrives. It also thrives in sector 5. It hates sector 4. Gold hates sector 4, because then when you have a healthy growth and healthy reflation, there's no reason to own gold. It's a healthy economy and real interest rates are positive. Nobody wants to own gold. There's no reason to own gold. But gold loves 1 as long as it's not a liquidity crisis. If and when a liquidity crisis comes, then you will see banks dump their assets, all of them, and that includes gold. So it just becomes a funding source.